January 24th, 2026. Silver just crossed $102 per ounce. Gold is trading above 4,987. The gold to silver ratio has collapsed from over 100 to 1 9 months ago to approximately 50 to 1 today. You are watching in real time what happens when a physical market breaks free from its paper prison. This is not a rally, this is a regime change. Understand what you are witnessing. For decades, silver traded as a financial derivative, a number on a screen determined by futures contracts in New York and London. The physical metal itself was almost irrelevant to the price. Paper claims outnumbered actual bars by ratios that reached 356 to 1 at their peak. The system operated on a single assumption, that most contract holders would never demand delivery. That assumption just died. The numbers tell you everything. COMEX registered inventories have collapsed 70% since 2020. London vaults have lost 40% of their holdings. Shanghai inventories sit at decade lows. The United States Mint suspended all silver coin sales on January 14th, citing inability to source metal at prices that make economic sense. This is not market volatility. This is systematic inventory depletion across every major vault on the planet simultaneously. Now we need to talk about what broke the system. China controls between 60 and 70% of the world's refined silver supply. On January 1st, 2026, Beijing implemented export licensing requirements, so strict they effectively ring-fenced nearly 65% of global refined silver for domestic use only. To export silver from China now requires annual production capacity of at least 80 tons and full government approval. Hundreds of smaller refiners and exporters who supplied Western industrial users and exchanges were cut off overnight. The timing was not accidental. The global silver market has run structural deficits for 5 consecutive years. Cumulative shortfalls from 2021 through 2025 total approximately 820 million ounces. That is nearly equivalent to 1 full year of global mine production simply gone, drained from above-ground stockpiles to meet industrial demand that mine output cannot satisfy. Solar panels consume 20 grams per unit. Electric vehicles require up to 2 ounces each. AI infrastructure, semiconductors, medical applications, power grid modernization. Every technological transformation of the modern economy runs on silver's unmatched conductivity. There is no viable substitute. China did not restrict silver exports because of trade disputes or economic leverage. China restricted exports because it looked at its own industrial requirements for the energy transition and realized there's not enough silver in the world to go around. This was a declaration that the era of abundant supply is over. When the world's largest refiner and a dominant industrial consumer simultaneously exits the global market, what remains is a supply crisis that cannot be papered over with futures contracts and cash settlements. This brings us to the most dangerous signal. The physical market has completely divorced from the paper market. In Tokyo and Dubai, actual silver bars are changing hands at prices as high as $130 per ounce. That is an 80% premium over the futures price quoted on COMEX. Read that again. Physical metal trades at nearly double the official exchange price. This is not a small arbitrage opportunity being exploited by sophisticated traders. This is the complete breakdown of price discovery. When industrial users in semiconductor, electric vehicle, and solar sectors need silver for production lines, they cannot wait for COMEX settlement or London good delivery. They need metal now, and they are willing to pay any price to secure it. The digital number on the derivatives exchange has become irrelevant to the actual cost of acquiring physical bars. Price and value have officially diverged. The screen shows one reality, the vault shows another. Here is what this divergence reveals. For years, the silver market operated as a confidence game. Exchanges held a fraction of the metal their contracts represented, betting that settlement could be managed through cash payments and fractional reserve mechanics. As long as most participants accepted paper claims as equivalent to physical metal, the system functioned. That confidence is now breaking. Industrial users demanding immediate delivery discovered that registered inventory levels are catastrophically low. Lease rates spiked to 8% annualized in January. You do not pay 8% to borrow silver unless the metal itself has become genuinely scarce and you are desperate. The mechanics of the breakdown are simple. Each futures contract represents 5,000 ounces of silver. At current delivery demand, COMEX faced requests for 65 million ounces in late December alone. The exchange reportedly struggled to fulfill these deliveries, leading to widespread rumors of cash-only settlements. Translation: the exchange could not deliver the metal. When a commodity exchange cannot deliver the underlying commodity, it ceases to function as a price discovery mechanism. It becomes a casino where the chips cannot be redeemed. Now we need to understand the real cause. This is not about China. This is not about speculators. This is about money. Every currency in the global system is being debased simultaneously. The Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China. Central banks worldwide are trapped in a cycle where economic growth requires perpetual monetary expansion, and perpetual monetary expansion destroys the purchasing power of the currency itself. Gold and silver are not rising. The measuring stick is collapsing. When gold trades above $4,900 and silver crosses $100, this is not asset appreciation. This is currency devaluation expressing itself through the only assets that cannot be printed into existence. Gold has climbed 80% year over year. Silver has skyrocketed 234% annually. These are not normal market moves. These are emergency signals from a monetary system under existential stress. The pattern is historically consistent. During the 1970s, when inflation broke the post-war economic consensus, gold rose from $35 to over $800. Silver surged from under $2 to $50. The Weimar Republic saw similar dynamics as hyperinflation destroyed the Reichsmark. Emerging markets from Argentina to Turkey have watched precious metals soar in local currency terms as confidence in sovereign debt and central bank credibility evaporated. What happens in those moments is always the same. People realize that holding cash is not safety. It is guaranteed confiscation through inflation. The Federal Reserve cut rates throughout 2025, bringing the federal funds rate from restrictive peaks down to 3.50% by December. Lower rates were supposed to stimulate growth. Instead, they confirmed what markets already understood. The economy cannot function at normalized interest rates without triggering recession. Debt levels across government, corporate, and household sectors are so elevated that even modest borrowing costs create systemic stress. The choice is between recession and inflation. Central banks chose inflation. That choice shows up in asset prices. When the cost of holding cash approaches zero and the currency itself loses purchasing power, capital floods into anything that cannot be devalued by central bank policy. Gold benefits as the ultimate neutral monetary asset. Silver benefits even more because its industrial demand creates a physical consumption floor under the price, while its monetary properties allow it to participate in the inflation hedge trade. This dual identity makes silver uniquely explosive in environments like this. Look at what else is happening. Bitcoin, which spent years being marketed as digital gold, is trading near $89,000, down 28% from its October peak of $126,000. In the same period, silver is up 234%, and gold is up 80%. The narrative of cryptocurrency as a safe haven has collided with the reality that when systemic stress hits, capital flows to assets with 5,000 years of monetary history, not 13 years of speculative trading. The dollar index hovers around 98 to 99, showing mixed strength. It rebounded slightly after President Trump softened his tone on European tariffs at Davos, but the underlying trend is weakening. Dollar strength in early 2026 reflects relative economic resilience and concerns about Federal Reserve independence, not absolute confidence. When investigations into Fed Chair Jerome Powell include criminal probes over headquarters renovations, confidence in the institution itself erodes. When the independence of the central bank becomes a political question, the currency it issues becomes a political risk. This is where the system breaks. Investors are not buying gold and silver because they think prices will go up. They are buying gold and silver because they no longer trust that dollars, euros, or yen will hold value. The distinction is critical. A speculative rally ends when sentiment turns. A loss of monetary confidence does not reverse until the underlying fiscal and monetary policies change, and those policies cannot change without triggering the recession that central banks are desperately trying to avoid. Global confirmation comes from everywhere simultaneously. Central bank demand for gold has transitioned from sporadic purchasing to consistent structural accumulation. Official sector activity added 297 tons through November 2025 alone. Russia allocates funds to buy silver. The United States reclassified silver as a critical mineral for national security. These are not investment decisions. These are strategic resource grabs by governments that understand the future will be defined by access to physical commodities, not paper claims. Emerging market central banks are accumulating silver alongside gold as both a monetary and strategic asset. This behavior represents a fundamental shift. For 70 years, the rule was simple. Central banks buy gold, not silver. That rule is breaking. When sovereign institutions begin treating silver as a reserve asset, the pricing dynamics change permanently. The available supply is finite. Industrial demand is structural and growing. Investment demand is exploding. And now government demand enters as a fourth pillar supporting prices. The arbitrage between physical markets confirms what the price action suggests. Shanghai physical silver trades at premiums over $80 per ounce, while COMEX quotes $71.50. That spread should not exist. In a functioning global market, arbitrageurs would buy COMEX contracts. take delivery, ship the metal to Shanghai, and pocket the difference. But they cannot. China's export restrictions make it impossible to move metal out. Western vault inventories are too depleted to generate surplus for export. The global silver market has fragmented into isolated regional pools, each fighting over whatever metal it can control. This fragmentation is identical to what happened in lithium and rare earth markets when physical shortages emerged. Once buyers realized that paper contracts cannot reliably deliver physical material, they stop trusting the exchange price as a meaningful signal. They go directly to producers, refiners, and industrial holders, offering premiums for guaranteed delivery. The official price becomes a fiction. The real price is whatever it takes to secure actual metal. Now we reach the lagging asset, the contradiction that exposes the illusion. Industrial silver demand should theoretically respond to high prices through substitution and efficiency improvements. At $100 per ounce, every manufacturer in solar, electronics, and automotive sectors should be racing to reduce silver intensity or find alternatives. That is classic economic theory. But it is not happening fast enough. The International Energy Agency estimates that by 2030, solar and electric vehicle sectors alone will consume half of global silver output. These are not discretionary uses. These are infrastructure and strategic technology applications, where silver's properties are functionally irreplaceable in current designs. Substitution research takes years. Certification and scaling take years beyond that. Even if alternatives emerge, the transition timeline extends well beyond the current supply crisis. The gap between current consumption and available supply cannot be bridged by incremental mine production increases. 75 to 80% of silver comes as a byproduct of copper, zinc, and lead mining. Higher silver prices do not incentivize new silver mines unless the economics of base metal operations justify expansion. Primary silver mines represent only 25 to 28% of global output. New mining projects require 8 to 12 years from discovery to production. Ore grades are declining globally. What this means is simple. The structural deficit will persist regardless of price. The only variable that can equilibrate the market in the near term is demand destruction through price rationing. Industrial users either pay whatever silver costs or shut down production lines. Solar manufacturers either absorb the metal cost or delay projects. The choice is binary, and in most cases, the cost of silver is still small relative to total project economics, so they pay. Speculators and retail investors add another layer. Global silver ETF inflows reached 95 million ounces by mid-2025. Physical demand in China and India remained resilient despite record prices due to cultural factors and lack of trust in financial assets. When retail buyers see silver crossing $100, some will take profits. But others will interpret the move as confirmation that the system is broken and increase their positions. Momentum in silver tends to feed on itself because the psychology shifts from trading to hoarding. Here is the final verdict. You're witnessing a complete repricing of silver's role in the global system. It is no longer merely an industrial commodity traded on exchanges. It has been upgraded to a strategic national asset, a monetary hedge, and a scarce input for every technology defining the energy transition. Those three identities create demand that mine supply cannot meet, and above-ground stockpiles can no longer buffer. The 5-year cumulative deficit of 820 million ounces has drained exchange inventories to levels where the system cannot function under stress. China's export restrictions have formalized what was already true. There's not enough silver. The paper market's inability to deliver physical metal has destroyed its credibility as a price discovery mechanism. And the monetary backdrop of central bank easing, currency debasement, and fiscal deficits makes holding cash equivalent to accepting guaranteed loss. This is not the end of a cycle. This is the beginning of a regime where physical scarcity defines value and financial promises are tested against the hard limits of geology, energy, and geopolitics. The old rules assumed infinite liquidity and fungible paper claims. Those assumptions are dead. What matters now is who controls the metal, who needs the metal, and how fast they need it. Forecasts from major banks see silver averaging $85 to $100 in 2026. Citigroup targets $110 for the second half of the year. Some retail sentiment surveys show a near majority expecting silver above 100 sustained. These are not speculative projections. These are attempts to model what happens when a market transitions from surplus to scarcity, from paper to physical, from derivative to strategic asset. The gold to silver ratio collapsed from over 100 to 1 to 50 to 1 in less than 9 months. That compression tells the story. Silver was severely undervalued relative to gold when the ratio exceeded 100. As reality reasserted itself through physical shortages and industrial demand, silver exploded higher. If the ratio continues compressing toward historical norms closer to 33 to 35, and if gold itself continues rising towards 6,000 or 8,000, The implied silver price reaches levels that sound absurd until you understand the math. A gold to silver ratio of 35 with gold at $8,000 means silver at $228 per ounce. You do not need to believe that outcome. You only need to understand that the forces driving it are structural, not speculative. The deficit is real. The industrial demand is real. The monetary debasement is real. The inventory depletion is real. The paper market's inability to deliver is real. Everything else is just math and psychology. Holding cash in this environment is a decision to accept loss. Cash pays no yield. Inflation runs at rates central banks cannot control without triggering recession. The purchasing power of every fiat currency is declining in real terms. Gold and silver are not investments in the traditional sense. They are exits from a system where the rules have changed and the old safe havens are no longer safe. Time itself has become the enemy. Settlement delays, shipment times, export approval processes. In a market where physical scarcity is driving prices, speed of access determines who gets the metal. Industrial users who waited for lower prices discovered there are no lower prices coming. Investors who assumed dips would provide entry points watched silver cross 60, 70, 80, 90, 100 without meaningful pullbacks. The psychology shifted from waiting for corrections to fearing being left out entirely. This is the moment. You are watching a market break in real time. The price on the screen is a number generated by contracts that cannot reliably deliver. The price in the vault is whatever it takes to pry metal from holders who understand scarcity. The gap between those two prices is the cost of illusion, and it is widening. The old system assumed abundance. It assumed paper claims would remain fungible with physical metal. It assumed exchanges could manage delivery through cash settlement and fractional reserves. It assumed industrial users would accept derivatives as hedges. It assumed central banks could print money without destroying its value. Every one of those assumptions is being tested. Most are failing. What comes next is not a return to normal. Normal is over. What comes next is a market where physical possession determines value, where strategic control determines access, and where the gap between those who own real assets and those who own claims on real assets becomes the defining wealth transfer of the decade. Silver just crossed $102. Gold is above 4,987. The ratio is 50 to 1. The vaults are empty. The paper market is broken. And you are here, right now, watching the system crack. The only question is whether you understand what you're seeing.